Hello, everyone. I'm Matt Clark, research analyst with Money and Markets, here for your weekend edition of the Bull and the Bear podcast. As we do each weekend, myself, Green Zone Fortune's co-editor Charles Sizemore, and our chief investment strategist Adam O'Dell will give you a credible pick that we have looked at and examined. We've spent the entire week scouring the stock universe and putting in our brain power to come up with these three stocks. Now, today you're going to get two. Adam O'Dell actually has a scheduling conflict. He is not going to join us this weekend, but with me is Charles Sizemore. He will be joining us. But before I get to all that, I do want to remind you to head over to moneyandmarkets.com after you watch this video or listen to this podcast and sign up for our free daily e-letter each and every day of the week, all 7 days. Myself, Charles, Adam, the entire team, we work very, very hard to make sure we're giving you safe and profitable investment information to really bolster your portfolio. So just go over to moneyandmarkets.com and sign up for that daily e-letter. You get it for free each and every morning. And we hardly even take holidays off, which, much to Charles and I's chagrin, we don't take days off. We want to work and make sure we're providing all that great information for you to help you become profitable in a safe and smart and simple manner. So make sure you check that out. Now, obviously, like I said, we're going to jump right into it. I want to talk about two companies. I know Charles has one. I have one. They are on completely different ends of the spectrum. You could not be more varied in terms of what these two companies are and what they do. So I'm going to first turn it over to Green Zone Fortune's co-editor, Charles Sizemore. First off, Charles, welcome back to Texas. Welcome back to the United States after your sojourn to Peru. You are back home in the Lone Star State. Let's talk about what's on your mind. What have you spent this week scouring the net and the charts and the graphs and the financial data and the dividends? What have you been looking at this week?
The shoe store. I'll get to that in a second. But so I started with the premise that, look, the economy is getting back to normal. It is in fits and starts, but as virus cases recede, vaccine rollout continues, the theme of 2021 is normalcy, the return to normalcy. So what I see happening is a big surge of what I would call frivolous purchases. Just going to the mall, going to the store, just going out and throwing money around because you can. Now, over the last year, I think we've all been guilty of, just out of sheer boredom, if nothing else, buying frivolous stuff on Amazon. You're just buying frivolous stuff on the internet, and just boxes magically appear at your front door full of junk you don't really need. But in that impulse moment, you're like, yes, I need this. Boom. Well, as we get out and just stores are, actually in Texas today, as of today, as of a couple days ago, Texas is now completely open. No restrictions, just open the doors. Let's do this. Probably a little premature, but that is going to be the theme across the country, little by little. And so, with no further ado, my completely frivolous purchase stock of this week is Boot Barn, ticker symbol BOOT, BOOT. As a proud Texan, and this is also a celebration of my return to Texas after 6 weeks of being away. But as a proud Texan, I can tell you there is nothing more gratifying and also frivolous than a purchase of a pair of boots. They are expensive. They are actually ridiculously impractical. I mean, you see the boot. It has a tapered toe, which is uncomfortable. It has a heel. It's actually, considering this is macho, masculine footwear, it's actually remarkably feminine. It has a high heel. It has a pointed toe. It's completely impractical for any purpose other than actually riding a horse. Yet most Texans do have at least one pair of boots in their closet that they bring out from time to time. I have more than one pair. I won't tell you exactly how many. I do have friends that have a ridiculous collection of exotic boots, everything from ostrich to hippo skin. Did you even know you could buy hippo skin boots? You can. So anyway, boots are a ridiculous expense, but they're fun. They are. And so this theme here is, look, people are going to get out as the economy normalizes. They're going to throw money around on ridiculous stuff, including cowboy boots. So Boot Barn, I like this stock because it rates exceptionally well across all of our metrics except for, one or two at the bottom. But sports an overall rating of 90, which is very firmly in strong bullish territory. The company, surprisingly, it's headquartered in California, which is not really the image you would expect for a boot company. For crying out loud, you'd expect it to be based in Texas or I don't know, just New Mexico somewhere, right? You would not expect California, but what do I know? They have a total of 260 stores spread across 35 states. At any rate, digging into the details, it rates highest based on growth. And this is particularly impressive considering what the last year has looked like. Now, of course, their growth story goes back further than the past year. Over the past, since 2013, they've actually compounded their sales at a 20% annualized rate, which is very strong for a purchase that frivolous. But what's also impressive is over the last 12 months, they've managed to grow their sales by about 7%. Now, think about that. This is, in-person retail has really been crimped over the last year. You don't have a lot of people going to stores throwing a lot of money around right now. This has been a just burning dumpster fire of a year for brick and mortar retail. And these guys still managed to increase their sales by a very solid 7% year over year. That's impressive. Momentum, this stock, I'm actually surprised it doesn't rate a bit higher. It rates only an 88 based on momentum, but from its 52-week lows to its current price, the shares have exploded by more than a factor of 8. I mean, these shares have just been on fire of late and don't look to be slowing down anytime soon. The company also rates really well based on quality. It rates an 85. Now, our quality score has a couple components. What drives the high score here for Boot Barn is primarily its high return-ons. It has very solid return on equity, return on assets, return on investments. It rates very, very highly across the board there, kind of straight 90 and above across the board. Value, it rates respectably well at a 69. That's not as high as some of these other metrics, but it's definitely solid. I like to see high quality, high momentum stocks trading at a discount, and that's exactly what we have here. It's pretty rare, honestly. When you see a high momentum, high growth, high quality stock, you're normally paying up for it. It's rare to get stocks that rate exceptionally high across the board like that and also get them at a good value score. But in Boot Barn, that's exactly what we're getting. And remember, value, all these metrics are backward looking. They're based on the historical data. I think the numbers are about to get a lot better because, again, the economy is normalizing. And Americans, if we are good at one thing, it is throwing money around on frivolous stuff. So I think this story only gets better. Now, where it drops off a little bit, this is not a small company. It's a $1.7 billion company by market cap. So it's middle of the pack based on size with a rating of 57. And volatility actually rates fairly low. It rates at about 29. This is a volatile stock. Any stock that goes up by more than a factor of 8 in 52 weeks is clearly going to be volatile. The beta is almost 3 on this. In layman's terms, that means this stock moves roughly 3 times as much as the S&P 500. So this is definitely a stock that will, this is like, I'm going to go here. It's like riding the bull at the rodeo. You just got to hold on for dear life here. I see you rolling your eyes. I'm just happy to be back in Texas.
I can almost not believe you did that. But then again, I can completely believe that you went there. So yeah.
I'm just so happy to be back in Texas. Anyway, this is a volatile stock, and my general rule of thumb on a volatile stock like this is keep your position size a little bit smaller. If your normal position size, and I'm making this number up, but let's say your typical position size is you put $10,000 into a stock. For something this volatile, I might say drop it down to 5 or something. A stock this volatile should be a smaller piece of your portfolio. But that said, volatility can work to your favor. Volatile stocks can shoot to the moon. They are a roller coaster ride. So that's it. That's my pick for this week. Boot Barn.
So Boot Barn trades under BOOT. Interesting of note. I grew up in Kansas, and Kansas was the home of Wichita, my hometown was the home of Sheplers. Sheplers is a big Western store. Is located out on the west side of town, out by the airport. huge warehouse and huge showroom floor and all that. Shepler's is now actually a part of Boot Barn. So I thought that was just a very interesting nugget. And as much as I understand that the two companies that we're talking about are completely different, the actual stories here are fairly similar. And that is kind of building on the idea that we're getting back to normal. Not Texas normal, or not doing it at warp speed, but things are getting back to a degree of normalcy. I don't know when. I don't know that we'll ever be back to where we were in 2019 until, I don't know, 2022, 2023, maybe. I think there's just going to be a lot of things at play there. But there are things like retail that are starting to come back and reach a small degree of normalcy, whatever that happens to be. And there's another sector that I think is also trying to build itself back to normalcy, and probably doing it with a little bit more expediency than retail. I'll back all this up by saying, when before I joined Adam and Charles on the team here at Money and Markets, I was the editor of a business publication in the upstate of South Carolina. The upstate of South Carolina is basically the I-85 corridor between Charlotte and Atlanta. And what makes this corridor so unique is that it is a manufacturing hub. There are manufacturing companies up and down 85 and then up and down 26, which runs between Spartanburg and Columbia, that support BMW manufacturing, which is the only U.S. plant to construct BMW vehicles in the United States. Any X vehicle that you see, the X2, 3, 4, 5, 6, even the X7, those are all produced in Spartanburg, South Carolina. Then there's Michelin North America, the famous French tire maker. Their North American production headquarters in the upstate. Between Greenville and Spartanburg. Borg Warner, this is a Michigan-based auto parts manufacturer that has a huge production facility and technical plant located near Anderson and Seneca, South Carolina, in that upstate. But the whole point of that is during my time there, I had the opportunity to talk with a lot of people that worked at those facilities, and I really liked being able to talk to the floor worker, the people that were on the line. And I wanted to get a better feel just for what they did and how they did it. And of course, there's a lot of fascination in manufacturing with robotics and automation. Those are the new buzzwords when you think about manufacturing. Is automation? How can we automate processes to where humans don't necessarily have to do it all? And how can we get robotics involved? Because robots take orders. And it's a lot more workable to management than it is to just have a 10,000 employee staff at a manufacturing facility. But it only goes so far. There's still a significant human element in manufacturing, and I think there's always going to be. I don't think you're never going to go into a facility and just be all strictly robots. I just don't think that's going. It's a nice dream, and it may happen in 3 decades. It's not going to happen anytime soon. Now, the challenge for each of these companies, whether you are the end user like BMW or Michelin, or whether you're a tier supplier or part of the supply chain like a Borg Warner, you always have to meet specifications. And Borg Warner doesn't just work for BMW. Borg Warner makes parts for a wide variety of companies, even Tesla, I believe. They make parts for Tesla, as well as Ford, GM, Volvo trucks. So they have different specifications that they have to meet, and these specifications are wide ranging, anywhere from the specific size of tire for a vehicle to sizes for parts for your car's Bluetooth interface or microchips. These measurements have to be very precise, and they have to be correct down to the millimeter, if not even smaller. Now, the company I'm going to talk about today specializes in providing hardware and software that allows technicians at plants like BMW and Michelin and Borg Warner and millions of other plants across the globe actually use three-dimensional measuring. And it's kind of an interesting thing. I had an opportunity to actually see this in action a little bit. Now, the three-dimensional 3D measuring allows technicians to really immerse themselves in the look and feel of a chip or a tire or an engine or whatever. And this company is a leader in the world of 3D measuring, especially for manufacturing. It's FARO Technologies Incorporated, trades on the Nasdaq. The ticker is FARO. It's based actually here in Florida. It's based in Lake Mary, Florida, and creates products like its FARO arm. This is a portable 3D measurement arm. It's basically a small arm about I can't quite proportion it on the screen here, but it's a good size arm. It's not big, but it's a good size arm that a technician uses and gets a 3D model and image of whatever that is they're trying to measure. And then they've also got their FARO Focus. This is a laser scanner that works to create a visual template that operators can use accurately and actually position components in a 3D world. Very cool stuff. I mean, it's been around for a while. It's just one of those things where it's kind of been prohibitive in terms of cost, but that has actually worked itself out, making FARO one of the leaders that companies go to for this type of measurement and this type of assembly. Now, it markets its products globally to a variety of manufacturing sectors, as I said, including automotive. Automotive is probably the biggest. They have a big following in Michigan with a lot of both tier one suppliers and end using manufacturers in automotive, and also in South Carolina as well. Now, the entire manufacturing industry, as everyone knows, is kind of like retail. It was especially brick and mortar retail. It took a pretty substantial hit in 2020 thanks to the coronavirus pandemic. Plants around the world were locked down, shut down for months at a time, and even when they did start to build back up, it was at a very limited, even still at a very limited capacity, and that had an effect on FARO Technologies as well. If I look at the actual projected total revenue, FARO reported total revenue of about $303.8 million in all of 2020. That was a 20% decline from the year before. But as lockdowns come to an end, manufacturing production starts to pick back up. FARO is expecting a relatively quick recovery from that down year. In 2021, projections have the company bringing in $348.6 million in total revenue, which is also very close to its 2019 figures before the pandemic. And then it's going to surpass and actually blow away 2019 figures by 2022 with about $391 million in revenue, and then $430 million in projected revenue in 2023. So that's a 41% increase in total revenue from 2019 and a 7% jump in revenue from its best year in 2018. So to put all that in perspective, FARO is not only going to start recovering, it's actually going to recover and position itself better than before the pandemic. I know that's a lot of numbers to throw out. I kind of want to put that in context for you. I also take a look at diluted earnings per share. FARO is going to see another dramatic jump in coming years. They had a loss of about $3.60 a share, and that was in 2019. That's actually going to grow to a gain of $4.70 per share by 2023. So if you think about that, if you just, no rough math or anything, that's a triple-digit gain in earnings per share in just 4 years. That's huge. I mean, that is a massive. It's very impressive to see on its balance sheet for sure. And if you're an investor, also something you definitely take notice of. And it's really a nice recovery for this company from the coronavirus pandemic that saw all of manufacturing suffer. The stock has already recovered pretty nicely from March 2020. It hit a 52-week low, about $36 back in March, but it's taken off, especially of late in February. The stock gained around 62% in the months following the coronavirus crash, but then only inched its way up after that. It kind of traded sideways. It didn't really move robustly, but then it had a massive jump in February, and it now stands at $92 a share, up from $36 a share. It's a 154% increase from March 2020. And I don't think that momentum is going to stop anytime soon. I also compared FARO to the S&P 500. That company stock is actually blowing the rest of the market away. FARO has gained about 65% in its share price in the last 12 months compared to just 28% generated by the broader market during the same time. Again, I don't think this trend is going to stop anytime soon. I also, another component to throw in there in my analysis is I look at Adam's six-factor green zone ranking system. FARO Technologies ranks an 89 overall, which again puts it in the strong bullish category. It is right there in that top metric. It's where we like to see stocks that we recommend or suggest that you look at. It's right in that sweet spot. It means we are strong bullish on the stock. We do expect it to outperform the broader market by at least 3 times over the next 12 months. FARO ranks in the green in 4 of the 5 metrics that we account for. In growth and size, it ranks a 77. In momentum and quality, it ranks a 75. And in volatility, it ranks a 69. All those are right in the green. Now, it does get a little low in value. It's a 45. And I think a lot of that is due to its massive increase in stock price of late. It's kind of put its PE ratios at a point to where it's kind of astronomical to look at in terms of what its price to earnings ratio is at this point. But a lot of stocks, even with the recent pullback, are still rather frothy. They're still rather overvalued. So I don't really see that as a huge concern. I still think there's a lot of room to run with FARO. It's a good growth. It's a good quality play. It's got strong upward momentum, very little downtrending. And I think, really my bottom line here is that manufacturing is making a comeback in a big way, not just in the U.S., but globally. Manufacturers are going to rely heavily on companies like FARO Technologies and their 3D measuring to get production lines not only back up to speed, but greatly improved and in a very short time. So I think that this is a stock definitely worth your time to look at. I think it's got a lot of potential. It's a manufacturing play. You could also consider this maybe even a smart tech play or a 3D technology play. A lot of different ways you can kind of angle this if you're looking for a different a way of trying to figure it out. That was another reason why I picked it. This is very diverse. I mean, you can look at it as manufacturing, you can look at it as three-dimensional, you can look at it as AI, you can look at it as smart tech, you can look at it in a couple different ways in terms of how maybe you want to position it in your portfolio. So FARO Technologies trades on the Nasdaq under FARO. Charles Sizemore, I'll leave you with a parting shot here. Let's talk about these two stocks a little bit.
Yeah, sure. Well, you bring up a point. Yeah, you're like, well, is it manufacturing? Is it AI? Is it smart tech? It's all of the above, because there's really this is a thing about the modern world. How do you even really say what a tech stock is now? I mean, is Chipotle Mexican Grill a tech stock because they had a cutting edge app before anybody else that allowed you to customize your burrito?
Exactly.
That's a silly example, obviously.
No, but I think there's credibility to that, because that is it's no longer a basket of tech stocks.
It's the line is blurred now. Essentially, everything's a tech stock.
Exactly.
Tesla, is Tesla an auto company or is it a tech company? Well, that's debatable. Right. Is Amazon a retailer or is it a tech company? That's debatable. So I think this kind of brings up a bigger theme about how pervasive tech is now and what that means for future productivity. I think the FARO is interesting because it is a play on manufacturing, but it's a play on automated manufacturing more than anything else. And that's it. Manufacturing is returning to America. One of the byproduct, this was already happening anyway, but a byproduct of the pandemic kind of sped this up. And that's companies are looking to shorten their supply chains, but in the same sense, labor is messy. It's complicated. Finding, skilled labor is hard. Getting them trained is hard. Getting them to stick around is hard. Machines don't leave. Machines don't need a raise. Machines don't, get sick. Machines don't go out on leave or take vacations. So it's, I think this is part of a good, durable, long-term theme.
And just to note, one robot programmer or one PLC or programmable logic control programmer can control 6 to 10 robots. So just to put that in perspective, you got one human that can control 6, and 6 can control a line. So that
this is how the robot revolution starts with Skynet and
exactly. It'll be Terminator in 20 years. But I still think there is a huge human element to manufacturing. I think there always will be. Now, I think it's
you need humans for that creative spark. What is it you're making? What is it? Why are you making it?
Right.
Who are you selling it to? Human interventions. Without that human intervention, there's no reason for any of this to ever get started, of course.
Exactly. And if you look at automotive isn't static. These models of vehicles aren't the same from year in to year out. And a robot only knows what it is programmed. But in order to get that programming and to make those augmentations to align it takes a human, and it takes a skilled human. And I think that's where AI
can look for improvements. AI can look for efficiencies. AI can take a process and make it cleaner, make it more efficient. But AI is not going to start it.
No, AI is not going to implement it.
No, exactly.
So to kind of put a bow tie on things, Charles talked about Boot Barn, interestingly enough, based out of California. But I'm sure a very heavy presence in his homestead, Texas. It trades on the ticker BOOT. I recommended FARO Technologies Incorporated, which is based here in Florida. It trades on the Nasdaq under FARO. So those are your two recommendations heading into the weekend. We'll have much more next week. We'll have the marijuana market update as well as a couple more recommendations for you on the Bull and the Bear podcast. Don't forget our week ahead, which will be coming out on Sunday to get you prepped and ready for the coming week, whatever it may have in store, whether it is high yield bonds, a tech sell-off, whatever, or a combination of the two, as it has been this week. Whatever that happens to be, make sure you check out our week ahead that comes out as well. So head over to moneymarkets.com, get signed up for our free daily e-letter. Myself, Charles, Adam, we contribute all the time. Our team works very diligently, very hard. We have a great team that helps us make what we do way better than what it was when we started. So they deserve all the kudos in the world, and we all work very hard to make sure we give you safe, sound, smart, simple, profitable information to help with your portfolio. I don't think I'm missing anything else. I hope everyone has a great weekend and gets things started on the right foot for the next week. For Green Zone Fortunes co-editor Charles Sizemore, I am research analyst Matt Clark with Money Markets and your host of the Bull and the Bear podcast. Until next time, everyone, safe trading.